discussing dividend and investing in dividends, and I guess hopefully paying our bills and retiring at some point in our lives on dividends or for the cash flow from dividend investments. So I guess I want to tackle, I guess, two main points. How much money you need, I guess, to live off of dividends or to be able to pay your bills and like general upkeep on your life, as well as kind of how to build a portfolio. Not exactly sure exactly how this video's gonna go and how long it's gonna be. We might have to break it up into two parts just because, keep it nice and organized. But let's start with how much money you would need to live off of dividends. So let's just categorize dividend. Yeah. So how much money? Well, if you wanted to, it depends. The better question to ask is what's your time frame? How long do you need to live off dividends? I know there's a bunch of videos on YouTube already discussing this topic, and this video might not even be needed, but I thought it'd be fun to put it into, I guess, more relaxing to put it in an ASMR version of a video so people could relax and, chill too, as well as, give my own 2 or 3 cents on the topic. So that's kind of why I decided to make this video, despite there being hundreds of videos already discussing the topic. But so dividends, how much money do you need? So if we wanted to retire right now, we would need, let's do a quick example. You're probably going to want to invest in something super stable. You know that the cash flow is going to be there and the company pays a healthy payout ratio. It's going to be around for maybe 15, 20 more years. So a company that I think that comes to mind is Verizon. VC Verizon. Dividend right now is about, oops, my pen. Dividend right now is about, it's a little over 4%, but let's just say 4% for easy math. So, let's say we had $1 million, right? And we put $1 million all into Verizon today at a 4% yield. Annually, we'd be making $40,000. Now, it doesn't seem very good, but bear with me. Like, this is just if we had to retire, like today. We're like, hey, we need this cash flow each year. I need this amount of money. And, that's how much we'd basically be getting if we had to live off dividends like today. But most of us don't have to do that, and it's not logical to do that. So I guess what I want to break down is, in my opinion, there's 3 different types of dividend companies you can invest. You got, we'll call them the aristocrats. I don't know if I spelled that right, but this is basically, we got Verizon, I think, in my opinion. You got 3M, you got Coke, you got Procter Gamble, you got big names, the list could go on. Maybe even, like KM, Kimberly Clark, things like that. Like, they've been paying dividends for a while, they increase it annually. It might not be a super big increase, like I think Verizon increases maybe about 2 to 3% per year, which in theory doesn't really beat inflation of money anyway. But it's just, it's something to consider depending on how stable you want it. So we got the aristocrats, that's one. Definitely super stable is the word to say. Like 3M, I think 100 years of dividend payments. They're probably going to keep paying the dividend, although just because they've done it for the last 100 years doesn't mean they will. It's just a relative peace of mind, but you got to see the future projection of the business, Next, we have the high risk, I don't know what they call them, high yielders, we'll call them. Yielders, is that right? So, man, they're usually energy companies. Like, I know Exxon was one. Dividend was like at 10% a few months ago. And now it's probably at like 8 or 7%. Maybe even 6 because it went up so much. Trying to think of what else. I know at one point, like Simon Property Group was one. A lot of the retail companies were not retail. Actually, the retail, like commercial have, let's say, initial yield of 6% plus. Wow, that's really bad handwriting. 6% plus. Then they're most likely, that actually is hurting my eyes. 6% plus. They're usually in this category. The reason for the yield, actually AT&T, yeah, AT&T. Reason for their high yield, maybe it's mostly because people don't have faith that they're going to maintain their dividend. AT&T's dividend is really high right now, maybe like 6 or 7%, because because investors don't think they're going to maintain it. It's got a lot of debt. They got a lot to pay back. Payout ratio is probably high too. Usually with these companies, yeah, the payout ratio is high as well. I think Exxon one quarter had to borrow money to pay the dividend because they didn't want to not pay it because that would hurt. I don't know. I guess investors. Is that smart? I don't know. I don't think so. Long term, it's definitely not. Short term, it might be. I don't know. But it's their decision. So these good initial yield, a little bit less stable, definitely more risky. Next we have the growers. So right now the ones that I'm looking at, it's mostly like defensive stocks. We got LMT, even like Northern Grumman, Clorox kind of is one. I don't think, why can't I think of anything else? I think we'll just keep those here. So these are growing from anywhere from like, let's say 6 to 12% annually. Annually, is it on the page? Annually. These, let's say, might grow, even like 3M that was growing like 4 or 5%, which is still pretty strong. But for the most part, these are like the big boy stable ones. The difference is these usually have a low starting yield. I guess these sometimes do too, but these are growing companies that are increasing their dividend aggressively annually. So the idea, I guess, is what I'm getting at is most of the audience watching this video is between the ages. I looked at my analytics of 18, we'll say, to 30. So basically 20-year-olds. It wouldn't make sense for us to dump all of our money into a Verizon stock or to continually buy it. I mean, I'm just talking about just Verizon or just aristocrats. Like, we want these growers. We want to try to identify them. Cool looking arrow. Identify them. Move positions in them. And so not only are we gonna get the dividend increase, and that compounds like a 7% compound or annual compound for like 5 years is crazy. Now that's to state that they may not continue to do 7%, let's say, but if the last, I think, 6 years, 5 years, Lockheed's been growing their dividend about 7 to 15% every year. They might do that for, let's say, 5 or 6 more years, maybe 3 more years. Even if it's 3, like, you're getting 7% on the 7% on the 7%. Like, actually, how do you do that? I should know this. 7% compounded. I don't remember, but anyway, I'm having a little brain problem, but that's a pretty big percentage when it adds up on the initial money. So the dividend is going to be, or the dividend on your initial investment is going to be much higher than the starting, or obviously the starting yield, but then investing in one of these, as well as the appreciation, because as companies increase their dividend, especially if people catch on, they want to be a part of that. So this usually, in theory, will drive up the stock price as the dividend increases as well. I mean, obviously this is kind of in like a bear or a bull market scenario. Like, there's a lot of other factors we have to consider. But, and I guess one thing to consider too is the last few years, like, despite Corona, but like, I guess companies have been doing quite well, and the market's been doing quite well too. So, and it's a lot of things we gotta consider. But for the most part, just real quick, our age group, most people watching this video, we're gonna want a majority of our companies we're looking growers. I'm not saying just these, I'm saying growers look for the ones 7 to 12% annual increase in dividends consistently. And gotta look at those, the payout ratio. Anywhere from about 25% to 50% is like kind of fine. Anything above that, it kind of gets a little messy. It depends again on the company, how much money they're making, and not how much money, what kind of market they're in. It really depends. 25 is a little low, but that means they can aggressively raise it if needed. Anything above 50 for a grower, it's kind of like iffy, you know. But again, it's not. It's my opinion. If it's like 80-90%, you don't really want to see that. You know, you want to see, especially if the company is growing the dividend, you want to continually see them like have this number be smaller, because that means they can grow it, but also keep their like net income or whatever high, so they can increase it, but they're also putting that money back into the business to grow the business so they can make more money and then increase the dividend in the future. So you gotta look for a certain ratio. What is the exact ratio? I don't know. There's no magic number, but just be anywhere from probably 30 to like 50%. I put 25 just on the low end, but you know, gotta use some judgment. It's also, you know, to be picky with the numbers, but yeah, you gotta be cautious of that. So it's definitely, in my opinion, you gotta have both the growers and the aristocrats. I do have like Exxon right now as a high yielder just because I saw it as a value play, but I don't think a lot of money should go in this, but I think some should, because at the end of the day, we are pretty young. We got a lot of time. We got literally have time on our hands. And if you can get in it, let's say a really high yield, and the company, you know, is consistent, stays with their business, you know, that could be a big portfolio changer. If you got some really high yielding company that like came back, like AT&T, if like we're young, if let's say we put some money in AT&T, we got that 7% yield, maybe in like 5 years they kind of bounce back, you're collecting that dividend, they're paying off their debt, then they start increasing the dividend, the appreciation goes up. Definitely, that's best case scenario, but gotta kind of use some judgment and assess some risk. That's the kind of risk you're taking when you decide to get these yielders. But you know, you gotta balance it out with the core. Need some aristocrats, but the growers are where long-term dividend increases are really gonna make it so you don't need to have this much money to invest to get to this level. There's like formulas and stuff you can look online, like let's say Lockheed grows 6% for the next 5-6 years, and then it goes like 4% for the next like 10 years, and my initial investment's like 10 grand. You know, what's my yield and all that stuff, the expected appreciation. That's all fun and stuff, and people, if you really want to do that, you could go look up those videos and stuff, but I don't know if it's necessarily needed for this discussion, because to me it's too much speculation. Like, so for me, I guess kind of what I'm doing right now is I'm identifying growers. I'm trying to pick out some price and stuff, like by using technical analysis to get in some good entries. I'm not too worried on the starting yield on some companies. Like Walmart, for example. Walmart is increasing their dividend like a cent every year. Maybe they increase it more, but where's I going with this? I forgot where I was going. It's not that important, but like their dividends increasing like okay, like a penny a year, but do I want to be a part of that? And it's also that type of business, but yeah, sorry, I forgot what I was mentioning with that. We'll put that off to the side. Let's go back to kind of the beginning, like how much money would I need to not get started actually, how much money would I need to like live off? So let's pick actually something else. Let's say our time frame is, let's say I'm like 20, I'm 24 now. Let's say like 25 years. Let's say I'm 50. Let's say 25-year time horizon. But then we also gotta, at that point, we gotta factor in inflation, like no doubt. Let's just say 3% a year. It's probably a little bit more, especially this year. During Corona, I think, in my opinion, it's a lot higher. 25-year time horizon. let's say each month, you know, you could throw in like 1,000 per month. Let's just say directly into dividend stocks, right? Let's say, again, it's hard to put into a number. Yeah, this is also important. If you get too focused on, oh, I need this much money to live off dividends, or I need like this amount of money to make this amount of money in like 20 years from now, I think it's easy to lose sight of the goal. That's to say that like in 25 years from now, things are going to be the same and the market's going to be the same and everything, and maybe dividend companies start slashing dividends because they just have to. Like, anything could really happen, but I think if you look at historically, you know, inflation's also kind of on our side. It's actually hard to say, but no matter what, inflation's going to probably happen the way that the markets and the world, or at least the U.S. economy, is moving. So naturally, companies' profits are going to increase because it's going to be inflated because of that's how it works. So riding that inflation, trying to get a little bit more, and being in companies that are going to be profitable, hopefully they return some money back to shareholders, is going to be kind of the goal. I'm not really emphasizing a money goal. It's more of, can I buy a good business that is making a profit that's going to exceed inflation expectations, make money, and then give some money, a percentage, to the shareholders. Those are the companies that I'm going after, especially the growers, the ones that I think that will be growing with technology increases, or like just a stable company that's still kind of growing because people want to clean their house more or something, or use those products. So I'm going to talk about how I'm building the portfolio. I guess how I've kind of been, but I've been a little bit hesitant because the market's just pretty excessive right now, and it's just hard to find value. But let's say we got a 25-year time horizon, you know, some market fluctuations in that amount of time shouldn't matter too much. I say that now, but maybe in a year or so, the market could be completely different. But let's just say in 25 years from now, the market will most likely be higher than how it is now. I want to, every month, let's say I'm going to put in like $1,000 into dividend companies. This isn't my goal right now. I'm just using a number because it's easy to work with the $1,000. $1,000, say, a month into some dividend companies. Let's say it depends again on the value. Like if, let's say, Lockheed Martin's at some really high, weird area, then I might not buy it. Now that's because I like to use technicals to buy some stocks, but you know, some people like to just dollar cost average. Every Monday of some month I just buy a stock. Some people like to do that, but to me, I think I like to use a little more technicals. It's just, I think, I don't know, I feel like I'm so in the technical world that if I were just to buy a stock at random and not really know the relative price where it's been in the supports, I think I would just be like, what am I doing? I think that's just a personal preference, obviously, but yeah, you can either dollar cost average or dollar cost, I spelled dollar wrong, average, or use technicals. That's the one that I use. Or I mean, you could look at like PE ratios and stuff, but at the end of the day, I guess you could look at the current dividend price, but sometimes you just gotta buy it and just say, you know what, it might go down, and that's fine because over time I'm gonna build wealth, and that's, yeah, so, yeah, build wealth. So, yeah, let's write down the most important thing that we're doing. We are buying quality companies that, I guess, increase dividends, profits. That's basically it. I mean, we could write more, but everything stems off of profits, basically. We want a company that's going to be continuing to make money more than not more inflation, but make money and increase their dividend more than inflation, so we stay above the trend. Even a 1% increase above inflation over 10 years is a lot better inflation, obviously, but like it's a lot better because you got that time exponential horizon. I kind of feel like I was kind of jumping over the place. That's usually how my mind works, but we got somewhat of a trend or some things on the page so I can follow it. So I was watching this one dude's video. He had, it was about, let's just say 700,000 in a dividend portfolio, and the yield was, it was like over 10%. Let's just say it was 10%, but it was definitely over. So this, on a $700,000 investment, over, I don't know, maybe it's 5 years, I'm not really sure. I don't even know if he was including the appreciation, not including appreciation on 70 grand a year on this $700,000. Now you obviously you got taxes and stuff. You got taxes, so maybe it's 10% to 15% depending on the bracket you're in. But anyway, 70 grand a year. Now, doesn't that obviously seems better than having $1 million into there? But this is the difference between a time horizon and needing something at this absolute moment. Most of us are in this. We don't need the money right now. We're chilling. We want to grow with the companies that are growing. I guess getting back to the original point. And that's what this person kind of did. I mean, I think they got a little bit like luckier, you know, buying dips, especially during Corona and whatever. But that's, again, being smart with your money. And why entries do matter. I mean, again, maybe they don't if you're looking at a super long-term horizon, but to me the entries matter because you also get some really good appreciation. But you can't be too greedy with the entries, just as being too greedy when you can't sell, being too greedy, I guess, what's that word? Being too hesitant, I guess, and not buying when something is of value and when the people aren't buying around you. That's when you gotta buy some stuff too. And take some chances and risks, but yeah. So, if you can get a portfolio to 10%, so that's, like, again, let's just do like a quick thing. So, just to kind of explain this, let's use Clorox again for the, actually, let's use Lockheed because I don't know the Clorox number. Right now, dividend per share, $2.60. So that's, what's it, $10? Let's see, was that, it's like, sorry, 2.6. We're gonna do some janky math right now. $10.04 each year, 40 cents each year per share, but per share it's like $3.60 or something, so that's like, I don't know, like 2% or something, but that doesn't matter too much. So let's say next year it increases by 7%, right? Get a 7% increase, so 2.6 times 7%. Let's do plus, oops, oh no, plus 2.6, wait, I'm not showing you guys, I'm sorry. So then next year it's 2.78, let's just round it. Let's say next year on that 2.7 it increases again by, let's say 6%, right? Now we add that, oops, add that to 2.782, sorry I can't see. So now we're at 2.94. Actually, that's 2.95, right? Let's just do one more year with a 7% increase. Take that number, add 2.95, just round it, doesn't matter too much. 3.156 times 4, so it's $12.62 annually. So let's just say over 4 years, let's even say we had like a $10,000 investment, right? What would be like our yield on cost? As this thing is growing, then you're getting that appreciation. Hopefully you're getting the appreciation. I just butchered that word, but again, we're kind of, let's just look at just the dividend. What it would be. So let's say you had, let's just actually say you had $1 million, right? You had $1 million. And the dividend right here, let's just say it was 2%. I think it's definitely more than that. Let's say 2.5%. Am I still on the camera? 2.5%. So your initial initial yield, I mean, actually, I want to mention this real quick. Most of us aren't going to be jumping in like $1,000,000, even like probably 10 grand into a stock every month, right? We're most likely going to be dropping like a couple $100 a week, maybe $1,000 a week, couple thousand. But so maybe we do like 10 grand this year, 10 grand this year, 10 grand this year, 10 grand this year, and that the calculation is going to be different. But for now, let's just use this example because it's a little bit more easy to explain and show. So I mean, at year one, you know, we're making 2.5%. So that's gonna be $2,500 or $25,000. So that's definitely lower than you got the Verizon over here. But now let's say after 4 years, what would that actually be? You know? Okay, I just wanted to figure out the price. If the Lockheed's dividend was 2.4, so it'd be $416 would be our purchasing price per share. So let's just use that example. So now we got to go down here. So we got $12.62 per share. Divide that by, I guess we could do 416. So now we're at a 3% yield. Yep. So here would be a 3% yield. It still obviously doesn't seem as good as that initial yield, but again, we're compounding this over a large period of time. But that start, actually, did I do that right? 12.62 divided by 416, yeah, the original purchase price. Yeah. I mean, I guess I didn't do a good example justice, but you can see in that amount of time, this dividend increased by 0.5%, as opposed to, let's say, something like this. Each year, this dividend is like, it's about 52 cents, I think. It's going to be increasing at, it's about 3%, so whatever inflation is, but let's say 3%, sorry, it's hard to see. So each year, basically, not each year, but for the first year, it's about 1.5 cents. Then the next year, it'd probably be 1.8 cents. I guess, yeah. Again, what I'm getting at is you gotta get in these growth stocks to build a portfolio if you're in this age group. You gotta identify them, though, but again, you gotta kind of buy them at a decent price. And you also gotta be like, hey, this business is gonna be worth something in the future. Because to me, I think, especially I think Clorox, just because I feel like the sentiment around, oh, I gotta clean my house more, I gotta use these different products. I think COVID definitely impacted like our generation or certain generations of people in houses about cleaning and staying a little bit healthier. I think that'll not only be a good company to invest in, but I think they'll continue to slowly increase their dividend. Maybe in the next few years they'll increase it pretty quickly, but I think this should be more of an aristocrat, but I'm putting in the grower just because the last few years they've really been bumping up the dividend. So yeah, I feel like I'm kind of just rambling now talking about it. So getting back, let's take everything, put it together. So how much money, I guess, would you need for dividends, and I guess how long, or what's your time horizon? So let's say I got 25-year time horizon. I'm realistically, let's just use this guy's example, like maybe $500,000. Maybe I get eventually a 10% yield on that because of growth, because of compounding over time. Maybe we can kind of include some, I guess inflation too. Yeah, it really depends, because in 25 years from now, this 70 grand's not going to be worth the same 70 grand as as it is today. You know, the time value of money, and like just that opportunity cost is going to be completely different. But we can continually try to shoot for a goal that we're going to be buying, again, just quality companies that are increasing increasing profits, or at least their margins, which I guess is increasing profits, and giving a small percentage of that back to the shareholders. And over time, by buying dollar cost averaging or buying from the technicals, over a long enough period of time, we're building a base of wealth and that is more important than a certain dollar cost or certain number we need to have $1,000,000 at this percentage, or you know what I mean. So just gotta pick the companies, and you gotta find some decent ones, but they should be pretty well known. But, you know, you always go with the aristocrats and get in with them, but again, you're not gonna be a millionaire overnight with this. Obviously, you're not gonna be a millionaire, maybe even 10 years, but you're building a base of wealth that you're gonna be able to extract from in the future. So it's important that even like today, like you're doing stuff where you're generating money on a cash flow basis, and then from that you're putting it in these things, because this isn't something that I guess should be the primary goal. You need something else first, you know, get that money. I mean, hopefully people have jobs or kind of plan on getting a job, and then using this type of wealth model as a big part of their portfolio of wealth that they can use in the future. I guess that's all I gotta say about this. But again, none of this is really financial advice. I'm just talking, just I guess whispering actually. Just some dude talking about his opinion and some things he's learned over the years about dividends and wealth, and you know, I still got a long way to in building my portfolio, and you know, buying when I think is valuable, and you know, hanging on, because that's definitely a lot of emotional roller coasters you might go through from this, and sometimes holding on to like stocks for a while like isn't the best move. You know, sometimes you gotta take profits where you can, and it might mess up the yield and stuff, but sometimes maybe you just gotta do it. So don't get in the trap, or not the trap, but the idea that if I buy a stock for dividend and it goes up like 1,000%, that like I have to stay in because I have to, you know, maybe taking that profit's more important, and waiting for some type of pullback on some other companies is, you know, trimming positions and stuff could make you more money. But then again, most people don't want to do that. They just want to buy something, know it's a good company, and over the next 10 years they're going to pay them some money each year. And I think that's a smart, healthy way of looking at it. But I don't think it's for me. I think I just love to look at all the numbers, love to look at all the prices, and just get in my own head about all the possible factors and things that could get into, like the trade or like investment. But yeah, as long as you stick to these goals, you know, or principles, let all the numbers take care of themselves, and focus on how much money you can be making today and being helpful to society. Once you get that money, you can start buying some stuff. But yeah, hopefully you'll enjoy this video. I don't think this was the best educational video, but hopefully it made you relaxed and you learned a little bit along the way, or maybe I said something in the right order and connected or resonated with you. So take care, everybody. Thank you for being here, and I'll talk to you some other video. If there's any questions, let me